Hello there! Welcome to this walkthrough of valuation exercise and results. This presentation is intended for those who are interested in the valuation process, be that as a practitioner or as a consumer of the valuation analysis results. This presentation is not intended to be a sales pitch deck, meaning it's not something that a financial professional would present to a client who may not have the financial background to understand and appreciate the details and nuances of the analysis. Before we begin, I should also mention that the analysis was done in April 2017, so the recommendations we're about to see should also be viewed from that time frame. McKesson is the company of choice here for this analysis, so let's begin. Before we jump into the valuation analysis and results, it's helpful to have a bit of context about the company we are evaluating. So we'll walk through a snapshot summary of McKesson, its industry and competitors, and its historical performance. We'll dive deeper into historical accounting data to extract insights about this company. After all, the past is a good indicator for the future, and historical accounting data is a very significant signal to how the company has made their choices in the past. We'll look through their cash flow performance and check for any signs of earnings manipulation through Baynes and Piotrowski score assessments, and then we'll dive into the valuation exercises themselves. Since McKesson is a pretty large, mature company that pays dividend, I've chosen three valuation methods that apply to this type of company: discounted cash flow, comparable company, and dividend discount model. We'll then wrap up this walkthrough with a conclusion and recommendation. So, who is McKesson? McKesson is a large healthcare company, number 5 in Fortune 500, in fact. It's a healthy company in an industry that is heavily regulated. It has a growing market due to the aging population and is growing mainly by acquisitions and consolidation. In 2014, they acquired a giant German pharma wholesaler called Celesio, basically their German counterpart. There is no major problem in their accounting data, trends or ratios wise. Their historical accounting data actually show a company that is pretty healthy and has made good choices in the past, with a result of a pretty decent free cash flow. There is no sign of earning manipulation through the Baynes and Piotrowski scores, and there are signs that the market is undervaluing the company, at least in April 2017. My recommendation for this company stock, whether you're an investor or an acquirer, is to buy. From the industry standpoint, McKesson operates in the healthcare industry. This is a heavily regulated industry for the reason that healthcare can be risky, and it can often involve life or death situation. The wrong pill or the wrong procedure can easily end someone's life. So there are a lot of federal and state legislation to follow for understandable reason. The healthcare market does continually grow thanks to the aging population around the world. As more baby boomers enter retirement, there are more demands for high quality long term care. In the US, there have been three notable federal efforts to reform the healthcare industry, and they are the 1970 Medicare and Medicaid establishment, the 2010 PPACA, Patient Protection and Affordable Care Act, or Obamacare, and the 2017 American Health Care Act, or Trumpcare. From the company's standpoint, McKesson is a 184 years old company based in the United States. They operate two segments: pharmaceutical distribution and health technology solutions. 80% of their book of business is in North America, Western Europe, and Asia. McKesson's growth strategy focused primarily on mergers and acquisitions to get scale. This is because their competitive advantage being the cost leader. Their technology segment is also geared in the mindset of price reduction. Fortunately, they do have a pretty strong brand recognition. Their large customer base shows some loyalty to McKesson's products and services. So, what exactly do they sell? McKesson sells pharmaceutical products to retail chains such as Walgreens and CVS, standalone pharmacies, hospitals, and medical centers. In fact, one third of all pharmaceuticals used in the US is actually supplied through McKesson. McKesson also sells medical supplies, 150,000 national brands, and their own branded medical products, along with medical office equipment and laboratory products. On the technology side, they sell operating systems to hospitals, mainly electronic health records or EHR systems, and other advanced IT solutions such as enterprise imaging and diagnostic imaging. Putting McKesson in the Porter's Five Forces frame helps paint a more comprehensive picture of this company. On the competitor side, they face a pretty high competition from folks like Cardinal Health on the distribution side and Apple on the technology side. The power of suppliers are pretty low. There are numerous suppliers in the market for McKesson. In fact, that side of the business is actually pretty commoditized. But on the power of the buyer side, they face a pretty significant amount of pressure from their buyers because the switching cost is low. McKesson's buyers are primarily insurance companies and healthcare programs. The threat of new entrants is low because there is a high barriers to entry. This is because the cost of research and the cost of new drug development are pretty high. The threat of substitute are pretty medium and significant. This is because similar products and services for lower price are available in the market and the switching cost is low. A SWOT analysis of the company revealed an interesting picture of McKesson's strengths, weaknesses, opportunities, and threats. On the strength side, they are the largest pharma distributor with a strong balance sheet and very solid liquidity position. They have a diversified product offerings and a huge employee and customer base. Their weaknesses lies on the fact that they rely on a very limited amount of business segments. They lack proper information processing services, and their technology segment is not strong enough. On the opportunity side, there is a growing trend of demand for healthcare, and there are an abundance of other companies looking to partner with McKesson and be acquired by McKesson. On the threat side, they do face intense competition, and there are some legal complications in patents and drug testing that McKesson has to face. Look, lastly, because of their size, they are less adaptable to change. So these are McKesson competitors: AmerisourceBergen, Pedersen Medical, Cardinal Health, Owens and Minor, and Henry Sheen. These are some pretty heavyweight competitors in the world of healthcare and pharma distribution. So now that we have some context about McKesson, let's dive into their historical performance, and we'll do this by looking at their accounting data. A capital structure analysis of McKesson shows a company that is pretty stable. On the liquidity and solvency side, current ratio, quick ratio, cash conversion cycle, and debt to equity ratio fluctuate from time to time, like most mature company. But in general, these trends are pretty stable or improving, which is good news to investors and acquirers. McKesson managements of their sales, inventory, and payables are also pretty stable and constant. Minor fluctuations do happen here and there, but overall it's acceptable. Inventory managements and payables management have actually improved in recent years. As acquirers and investors, it is important to know what our money will get us. A DuPont analysis shows us what our return on asset, or ROA, and return on equity, or ROE, will be. More importantly, as we'll see in the next two slides, a DuPont analysis shows us the drivers of a company's performance, which is very important when one is to acquire or invest in a company. While McKesson's ROA and ROE have fluctuated over the past 15 years, like other companies, in general the trend is up and to the right. The company continues to grow and generate a good return for its shareholders. When we look at the five drivers of performance, McKesson's trends are pretty good. Tax burden fluctuated, mostly because of tax rates and levels of profit, but mostly stable. Interest burden increases due to the higher use of debt than equity, but this is good, since debt is a cheaper form of capital than equity due to the tax shield. EBIT margins increase constantly, reflecting better profitability over time. This is what we want to see with a company like McKesson. Total asset turnovers was declining up to 3 years ago, but there are signs that the company is making headwinds into improving asset performance. Leverage or debt is increasing, as I mentioned earlier, but in a positive way as the company actively acquire other companies and using that cheaper debt to finance their transactions. So, with all of those acquisitions as a growth strategy, what can we expect from McKesson's accruals? Well, with an active acquisition strategy, we can expect McKesson's accrual balances to fluctuate drastically over time. The peer companies that McKesson acquires typically has a lot of accruals on their books. Fortunately, McKesson's management has done pretty well in cleaning up accruals after each acquisition, presumably in preparation for the next acquisition. I wouldn't even be surprised if cleaning up accruals is a part of McKesson's acquisition playbook and integration plans. Looking at McKesson's asset base composition, we see a positive trend with inventories and receivable. There is a fluctuating cash balances over the 15 years of historical data, but they are within normal parameters for this business. Net PP&E and long-term assets shows that management continues to invest in future growth, which is the right thing to do for McKesson. As one can expect from a company who relies on acquisition as a growth strategy, McKesson's goodwill increases with every acquisition. That said, there are signs that the company consciously perform impairment tests every 3 years and recorded asset write-downs when it's appropriate. Again, this reflects positively on management, showing that they are good stewards of the company. When we look deeper into McKesson's capital allocation analysis, we do see opportunities to improve. McKesson's pharma distribution segment does deliver a significant advantage on gross profit, but at the cost of using more resources to generate those profits. The technology segment, from a cost benefit standpoint, is a more profitable segment to be in, and McKesson would do well to shift more capital towards that segment. Fortunately, management recognizes this fact, and in June 2016, they announced the formation of a new health information technology company with Change Healthcare, where McKesson owns 70% of the new company, valued at $3.4 billion pro forma annual revenue. From a historical cash flow perspective, we see that the operation cash flow is a major source of cash for the company, and in the investing cash flow is a major use of cash for the company. This is a good trend to be expected from such a mature company. With a huge acquisition of Celestio in 2014, investing and financing cash flows had major fluctuations. But as typical of their playbook, McKesson's management quickly brought those levels back towards normal parameters. I would even venture to say at this point that the company has demonstrated that they are a good serial acquirer. Volatility-wise, operating cash flow has a low volatility, indicative of a mature company that sells medical equipment with a need of PP&E to assemble and store and move inventory. On the free cash flow side, over the past 15 years, the trend is positive. Free cash flow to firm and free cash flow to equity has increased, indicating good management that continues to deliver value to shareholders. Trend analysis on revenue and asset measures also shows a strengthening ability to generate cash, at least enough to meet debt and interest obligation. Overall, the company has operated well historically. So one might ask if the financial statement of this company can be trusted. After all, earnings management is common. Well, not for McKesson. Using the Banish assessment, which is a financial analysis technique meant to uncover any alteration to depreciation rate, the delay of expense recognition, early sales registration, and other earnings manipulation tricks, we looked at McKesson's historical data, and McKesson scored pretty well in the no earnings manipulation detected zone. We can also use the Piotrowski score to assess McKesson. This is another way to check for earnings manipulation, basing the assessment on profitability, leverage, liquidity, and operating efficiency. Again, McKesson scored pretty well in the no earnings manipulation zone, and their score actually reflected a company that is in a good financial condition. So now that we have evaluated their historical performance, it is time to dive into McKesson's valuation, which is the purpose of today's presentation. As I mentioned in the past blog posts on valuations, there are a lot of approaches to value a company. Each will yield different values. Hopefully, when applying approaches intended for a specific type of company, the approaches will yield values that converge into the same range that will tell us if the valuation are in the right ballpark. In terms of gathering information needed for the valuation analysis, we can proceed either top down, bottom up, or adopt a hybrid method that combines both. That is what I've done in this McKesson analysis. I used the company's 10 case reports, industry reports, market data, and general economic data from the healthcare industry to find the free cash flow that I need for DCF and comparable company. I also adjusted the financial statement by normalizing for any extraordinary, non recurring gains or losses. So here are the assumptions that I used for McKesson's valuation analysis. These items were developed using the data I gathered earlier, and they are developed as follows. The sales growth rate were approximated as a top-down number. I used the OECD long run and short run US GDP growth rate and President Trump's target US GDP growth rate of 3% as a Monte Carlo element. The result is a 2.5% long-term free cash flow growth rate for McKesson. I then applied a 26% relative better measure, which is basically an indicator that the healthcare industry has overall performed 26% better than the combined market in the United States. Lastly, because sales is a function of unit price and volume, and we see a downward price pressure from the government on unit price and the upward pressure on volume through the aging population, I applied a 0.5% addition to that long-term free cash flow growth rate. The 0.5% came from Senator Rob Portman statement. He was quoting the Pew Research that every year 1% of the population, which is basically the baby boomers, retire and added to the volume of population that requires healthcare. Since volume is half or 50% of the function in sales, I applied a 0.5% measure to this long-term free cash flow growth rate. The result is a 3.6% sales growth rate that includes the GDP, the healthcare industry relativity, and the aging population. Tax rate was approximated using a hybrid method. This company historically have paid a 30.3% corporate tax rate. I use also President Trump's goal of 15% tax rate for corporations, but because I believe that only 20% would be attainable, I use the 20% as a Monte Carlo element as well. The result is a 21.8% tax rate. I approximated a few items as a percent of sales using a bottoms-up approach, assuming that past performance will be reflected in the future. I took the historical average of the last 5 years when it comes to account receivable, inventories, net PP&E, accounts payable, debts, accrued liabilities, cost of goods sold, SG&A, and I applied a Monte Carlo analysis on these variables using their minimum and maximum range of those 5 years. Everything else was approximated bottoms up. That means the depreciation and amortization, interest income, payout ratio, And there are a few items that are fixed at the 2016 level, such as cash, current portion of long-term debt, common stock, and others. To properly perform the discounted cash flow and comparable company, we need to find what McKesson's weighted average cost of capital or WACC is. To do this, I use the capital asset pricing model to find the cost of equity, and I calculated McKesson's cost of debt from the past 2 years. Using the current capital structure of 16% debt and 84% equity, I calculated the WACC. It's worth noting here that there are calculations based on past data, again, assuming that management will make similar choices in the future as they had in the past. In addition to WACC, a proper DCF and comparable company analysis required a pro forma income statement and balance sheet so we can approximate what future cash flow would be. We also need to project and calculate the present value of non-equity claims so we arrive at the right ballpark for equity value in this analysis. Having gathered all of the materials that we need, we calculated the terminal value, value of operations or enterprise value, and equity value of McKesson to determine if the stock price is fairly under or overvalued. I calculated the theoretical share price and compare it with the market share price. If the market price is lower than the theoretical price, it's worth buying the company's stock, whether you are an investor or an acquirer. The adage is, as some of you know, buy under value, sell over value. Moving on to comparable company. This is the second valuation method I use to value McKesson. Using the peer companies that the S&P Capital IQ has identified as peers to McKesson, I calculated the total enterprise value multiples to revenue, EBITDA, and tangible book value for McKesson. After evaluating the minimum, maximum, mean, and medians for these multiples, I concluded that the appropriate market multiple for McKesson is 8.5 times EBITDA. We'll see this multiple again in a later slide about the valuation analysis results. Similar to the DCF exercise, I calculated the terminal value, value of operation or enterprise value, and equity value of McKesson using the comparable company method. Also similar to the DCF, to determine if the stock price is fairly under or overvalued, I calculated the theoretical share price and compared it with the market price. If the market price is lower than the theoretical price, it's worth buying the company's stock. Moving on to the dividend discount model, this is the third and last valuation model I used to value McKesson. I derived the long-term dividend growth rate from historical data, forecasted future dividends, and discounted them back to present. For the terminal value, I forecasted future stock price at the end of a 15-year future horizon and discounted it back to its present value. This calculation uses the book value of equity and the market stock price at year end from the last 15 years to calculate the market price as a multiple of book value. Once I have the 15 multiples, I chose the average of the last 5 years as the multiple to calculate the projected market equity price 15 years from now. Lastly, I discounted that future price back to present to get the terminal value. Similar to the DCF and comparable company exercises, I calculated the equity value of McKesson using this dividend discount model method, and to determine if the stock is fairly priced or underpriced or overpriced, I calculated the theoretical share price and compared it to the market share price. If the market price is lower than the theoretical price, it's worth buying the company's stock as an investor or an acquirer. I can't say this enough. Buy under value, sell over value. So this is the result of our valuation analysis, and it shows a pretty interesting result. Discounted cash flow shows an undervalued stock for McKesson stock. Comparable company, as measured by total enterprise value to EBITDA, is also showing undervalued stock. Dividend discount model shows a fairly valued stock. So we have a convergence between the DCF and the comparable company analysis. Using a two-factor scenario analysis, I proceeded to test the possible range of stock given the WACC, long-term free cash flow growth rate, EBITDA multiple, and long-term dividend growth rate. While this exercise was insightful, it's not as robust as the multivariate model that we'll see in the next four slides. In the next four slides, we'll see a multivariate model in the form of a Monte Carlo analysis. So this is a Monte Carlo analysis result that was returned by our DCF model from earlier. For those that are not familiar with Monte Carlo, it is basically a what-if scenario analysis when more than two underlying variables are represented as a range of values according to a probability distribution. The analysis also consists of running simulation, mimicking real-life parameters several thousand times to see what outcome might happen in the future. So our DCF shows that 90% of the time, the fair stock price will fall between $265.30 and $279.60. According to this model, the top five factors driving the stock price are the market risk premium, SG&A, COGS, beta, and net PP&E. The Monte Carlo for the comparable company shows that 90% of the time, the fair stock price will fall between $201 and $207.30. Notice that this range is pretty tight, which is what we want from such analysis. This model also named the top five factors driving the stock price to be the SG&A, COGS, market risk premium, beta, and the total enterprise value to EBITDA multiple. Our dividend discount model shows that 90% of the time, the fair stock price will fall between $157.30 and $160.80. The top five factors driving stock price according to this model are the market risk premium, beta, SG&A, and COGS, and risk-free rate, which is the 10-year Treasury bond yield in our calculation. Notice that all three models pick different top five factors. So, our conclusion between the three models are that the top four factors driving the stock price are SG&A, COGS, market risk premium, and beta. Further, the models predicted that if McKesson stock was bought in April 2017 for $145.40, it can be sold later at a higher price. The DCF model predicted that that probability is over 93%. Comparable company predicted that it'll be over 88%. And dividend discount model predicted that it will be over 68%. So, we are coming to the end of this presentation, and my recommendation is that McKesson, being a large healthcare company, number 5 in Fortune 500, it being a very healthy company, even though it's in a heavily regulated industry, it does have a growing market due to the aging population, and its growth strategy has been acquisition and consolidation. Their historical accounting data shows that it's a pretty healthy company with a history of making good choices in the past. It has a pretty decent cash flow. Apologize there for the slight error. And it also has no signs of earning manipulation. There are signs of the market undervaluing this company in April 2017. My recommendation for this company stock, if you're an investor or an acquirer, is to buy. So you may ask, why is the stock undervalued back in April 2017? If the company is so great, why is the market not valuing it at a higher price? Well, this is a screenshot of the Wall Street Journal back in April 2017 on the 20th, in fact. It says, rattle investors seek shelter amid global political tension. What this article was talking about was a current trend at that time for a fight to save capital such as gold and Japanese yen. Investors are fleeing from U.S. companies due to political volatility caused by the Trump administration, And there are also further political instabilities around North Korea, Syria, Russia, and Brexit. In addition to in McKesson's case, because they are in healthcare, there were a lot of uncertainties around healthcare regulation as the American Healthcare Act failed to pass in the House at the time. But it's not all doom and gloom. Lower price means it's a good time to buy. So that is my recommendation. Buy now when the stock is undervalued. Later on, when the price gets back to normal, you can always sell it at that better price. So we have come to the end of this presentation. I'm sure there are a lot of questions all around. If you find yourself having any questions, please don't hesitate to email me at francinePway@gmail.com. Thank you for listening today, and I look forward to bring future presentation on other topics to this blog.